This is part 3 of the REIT industry analysis. REITs are companies that own or finance income-producing real estate across a range of property sectors. Most REITs are publicly traded. These are not an industry like semiconductors or airlines, but they're actually a type of asset. People can invest in portfolios of real estate assets through individual stocks, ETFs, or mutual funds. REITs of all types own more than $3 trillion in assets across the U.S. Exchange-listed REITs own approximately $2 trillion with a market cap of over $1 trillion. REITs were created by Congress in 1960. The REIT Act was signed into law by President Eisenhower, and they were created in order to give all investors the opportunity to invest in large-scale, diversified portfolios of income-producing real estate. REITs must pay out at least 90% of their taxable income to shareholders, and most pay out 100%. In turn, shareholders pay the income taxes on those dividends. And this is just a list of the different types of real estate investment trusts that exist. It's a partial list. You have residential, industrial, retail, consisting of malls, big box retailers, lodging, infrastructure is a pretty varied segment. You have healthcare, and then it's a classification called specialty, and that encompasses things like movie theaters, casinos, farmland. Timberland is another one that's kind of a lesser known REIT. So how do companies qualify to be a REIT? So they have to invest at least 75% of their total assets in real estate, and then they have to derive at least 75% of gross income from rents from real property, interest on mortgages, financing real property, or from sales of real estate. They must pay at least 90% of their taxable income in the form of shareholder dividends each year. They must be taxable as a corporation and managed by a board of directors or trustees. They're required to have a minimum of 100 shareholders, and no more than 50% of the shares may be held by 5 or fewer individuals. So why would someone be interested in investing in REITs? So REITs have historically delivered competitive total returns based on high, steady dividend income and long-term capital appreciation. They have a low correlation with other assets, which makes them a very good portfolio diversifier that can reduce the overall portfolio risk and increase returns. These characteristics are similar to investing directly in real estate, but they don't come with any of the headaches of tenants, property management, or financing arrangements. And this slide just goes over historical performance of REITs. I was pretty surprised to see that the basket of all equity REITs, they've outperformed both large cap and small cap indices over just about every single time frame for the last 40 years, if you remove the 3-year and 5-year returns. So anything longer than that, REITs have been the best place to park your money compared to large cap or small cap, and they've far outproduced the bond index. And so there's a bunch of different subsectors of REITs. There are definitely winners and losers in our strange new world we're living in. Communication towers began converting into REITs in 2011. American Tower was the first one to make the switch. That company has richly rewarded its investors since that time, generating a 335% total return, and that's easily outpaced the S&P 500, which has returned 155%, and the Vanguard Real Estate ETF, which is the largest REIT ETF, has returned 119% during that time. So American Tower has nearly tripled the largest REIT ETF over the last 9 years. The main reason why cell tower REITs have stood out versus other REIT options is that they've rapidly grown their funds from operations. There's been a significant rise in mobile data consumption on cellular networks, and that trend's expected to accelerate with the deployment of 5G technology. Cell tower REITs should be able to continue growing their funds from operations and dividends at above average rates over the long term. Cell tower REITs offer something not found in most real estate investments, and that's rapid growth potential. So instead of paying high yields like traditional REITs do, most of these companies reinvest a large portion of their cash flow to build and buy new infrastructure, and that trend is also likely to continue. So they stand out as one of the biggest winners. Retail is unfortunately probably the biggest loser. They've been most impacted by the pandemic as mandated store closures, physical distancing requirements, and tenant bankruptcies have disrupted traditionally stable cash flow streams. Already negative ratings could grow more negative if the recession is more severe than expected and hinders recovery prospects. The largest structural threat to retail REITs is the shift in consumer shopping habits. The explosion in online shopping benefits retail REITs while traditional retail struggles. Significant cash flow volatility is expected in the near term due to rent deferrals, increased bad debt expense, and bankruptcies of the various retailers. An accelerated pace of store closings will keep the outlook negative throughout 2021. Thank you for your time.